Hey everyone, I'm Johnny FD, and I'm really excited to be making this video because I've had a lot of friends asking me in DMs on Facebook saying, Johnny, how do I start investing? Should I invest it with a Robo advisor, with Vanguard, buy stocks, do this or that? How do I do it? And how much should I put in? Should I put it all in once? Should I put in a little bit at a time? When do I start investing? Is it the bottom yet? And in this video, I want to address all of that and also just show everyone who's just getting started with investing the proper way to do it so you don't end up losing your shirt or making any big mistakes. I've been very, very fortunate in the last 10 years that I've been investing. I've had a lot of great mentors. I've had a lot of people help me out. And if you watched my last video, the one where the title was how I made $22,000 in one day with stock trading, that was kind of a clickbaity title because technically my account went up by $22,000 in a day, and it went up today by another $3,000 or $4,000. But here's the thing: if you're not selling the stock, you didn't make it, and you're also not you didn't make it yet. It's a paper gain, and it's not in your pocket yet. And second, the stocks fluctuate up and down all the time. So one day you might be celebrating a $3,000 win, and the next day it might be down $3,000. And usually it doesn't go as fast as every day, but every month it goes up and down. And if you look at my portfolio in Vanguard, that's what's happened. But what's really, really nice is on average, it just slowly goes up. And yeah, we had these sudden drops. Like right now in March 2020, we had the coronavirus pandemic. Markets are freaking out, it's tanking. But I'm gonna get into all this on why I'm not scared. I think a lot of people would wake up and they would see $40,000 missing from their account and they would freak out, they would sell everything and they would lose a lot of money. But in today's video, I'm gonna explain to you how to do this properly, how to have the right mindset, have the right plan, so you can participate in the upside and make a lot of money and not be the ones that end up losing a lot. Because a lot of people are going to lose a lot of money during this time, and it's going to suck. But because you are subscribing to my videos, if you haven't subscribed yet, please hit the subscribe button. I want to help you guys out. I really do. I genuinely do. I'm not a financial advisor. I'm not going to take any fees from you. I'm also not going to push high commission products on you that they normally do, or tell you to start trading options and buy my options course, because I don't have one. I'm going to show you exactly what I personally do, what I recommend to my friends, to my family, and what I would recommend to you to get started. So if you're ready to get started, let's do this. All right, so I'm going to share with you a bunch of steps today. The very first step is you want to educate yourself and develop a plan. Watching this video is a big step in educating yourself, and I'm going to try to squeeze in as much info in just this video, where even if you didn't do anything else, you'd probably be okay. But I do recommend you read a book or listen to an audiobook. There's two that I recommend. One is Simple Path to Wealth by J.L. Collins, or Tony Robbins' Unshakable. They're both on Audible or audiobooks. And the reason why I really like these two books is they give you kind of a good foundation and the mindset of why you shouldn't buy individual stocks, why that's gambling, why index funds have always done better and probably will continue doing better, why low-cost index funds are so good. But really, mainly, it's the mindset of creating a plan and not selling when markets are down. Here's one thing I want everyone to understand before we move on, is it doesn't matter if the stock is up or down. So when I tell you my stocks are up by $5,000 today compared to 2 days ago, it's true. But at the same time, that's on paper. It really doesn't matter. It's a bunch of zeros. And unless I cash out, I didn't make or lose anything. I still own the exact same amount of stocks. Right now, I have about, let's say, 1,000 shares of stock. To make it very simple, it doesn't matter if those shares are worth $200 a share, or now they're down 50% and worth 100. I still have the exact same amount of shares. So what I could do is buy more at a discount to get the average price of those shares down, or I can sell take a loss, or I can just hold it, and as it goes back up, I can sell it then and actually make money from it. So that's really a key concept that I want everyone to be familiar with. So how do you actually buy these shares? The easiest way is to go through any kind of online broker. I like using Vanguard because I buy mostly index funds, but I also have an account with Charles Schwab, which I mainly got because they have a really cool ATM card. It's only for Americans, sorry, but you can use your card anywhere in the world and get your ATM fees reimbursed when you have one of their brokerage accounts. It's kind of like a thank you for having a stock account with them. To be honest, the reason why I started with Vanguard and I never used Schwab except for buying my Facebook stocks, which I talked about in the other video, is because they were charging an $8 fee every time you would trade. They've gotten rid of that fee, so it's actually $0 now. So actually, as of 2020, I would recommend just opening a Schwab account if you're American and just getting everything through there, because you can still buy and sell Vanguard accounts or index funds through Schwab. So that's actually an easy pro tip. You can have them be your online bank, your ATM, and your brokerage account. It makes it easier to have one login, but also for taxes at the end of the year, instead of having a bunch of forms, driving your accountant crazy, you can just have forms from this one place, and it makes it a lot easier. So if you are international, you can find an international broker, and literally there's one called International Brokers that I have some friends who use and they like. But you could also check your country to see what brokers have low trade fees. In the US now it's $0, but it used to be $7 a trade. And if you're buying, $10,000 worth every time, a $7 fee isn't that big of a deal, so it's fine. But if you're buying a couple $100 worth, you don't want to pay $7 every time. The percentage is too high. So it really depends on your situation. But check out Interactive Brokers, or check out whoever you can buy a Vanguard fund through in your country, and just make sure that fee is still low. In the US, VTI, which is Vanguard's total US stock market fund, is 0.04% or basis points. So it's a very, I think it's 0.004%. So just make sure it matches or it's relatively close, and that way you're not getting screwed. But in general, if you're buying a Vanguard fund, you're getting charged that Vanguard expense, so it's pretty low. When you're setting up the account, they're gonna ask you a bunch of questions like how much money do you make a year, and then some kind of psychology questions like, if the stock market dropped by 20%, what would you do in this situation? Just be honest with these things, because first, the income and net worth questions, what they're trying to find out is if you're an accredited investor or not. If you're accredited in the US, means you have more than $1 million net worth, or you're making over $200,000 a year, you have access to some different investments. But don't worry about that, because we're not going to invest in those anyways. So you can just be honest. They're not going to reject you because you make too little money. Second, for these questions, these psychological questions, it's to get to know what you would do so they can advise you better. So it's really to help you. So if you are the type that you would panic and you would sell everything if everything dropped, answer that honestly so they can help you. In fact, if you are the type where you think that you might panic and sell if things drop by a significant amount, by 50% or more, maybe actually don't go 100% stocks, maybe go 50% bonds, which are a little bit more stable, or use something called a Robo advisor. And that's the big second question people ask is, should I buy stocks through a broker like Vanguard or Schwab, or should I use a Robo advisor like Wealthfront or Betterment? I have accounts with Wealthfront, Vanguard, and Schwab, so I can kind of speak on all these. As I said, I really liked buying Vanguard funds through Vanguard because it was free, but now that Schwab is free, to be honest, I would probably just buy it from Schwab starting today, and especially because their website is way better. Vanguard's website looks like it was made in 2002 and hasn't been updated, and some things are still annoying. You still have to mail some things in. Schwab, everything's online. So actually, I would recommend Schwab for everything. Now, if you want to go robo-advisor, there's Betterment and there's Wealthfront. We actually interviewed the CEOs of both companies on our podcast, Invest Like a Boss, that I'm a co-host of. And they're both smart guys, smart companies, good companies, so I trust both of them. Their fees are very, very similar. I think Betterment ends up being cheaper if you have over 100 grand in there, but it's so similar that it almost doesn't matter. I have a referral link to Wealthfront if you want to get the first X amount managed for free, because I'm a member as well. But I don't really care that much about it. Basically, at the end of the day, you're never going to make as much money on the high end using a robo-advisor than if you invested directly. So if everything is good, you will make way more doing 100% index funds through a Vanguard index fund. Let's just say the total US stock market, for example. The upside is way higher. The reason for that is robo-advisors, they will always force you to be in some other things. I'm gonna log in my account, I'm gonna show you what else they're forcing me to be in, even though my risk is 10 out of 10. And they got this risk factor by those survey questions that they asked me. All right, guys, so this is my Wealthfront account. This one I have about $14,500 in, and you can see that my risk score is 10 out of 10, which means I answered all the questions that, hey, I'm young, I have other money, this isn't my main account, so just make it as risky as possible. So you would think they would put 100% of my money in stocks, and they don't. Yes, I mean, all these four are technically our stocks, so really only 10% are in other, but I don't need to be in municipal bonds at all. I don't need to be in natural resources, and then I don't need to be in low kind of growing dividend stocks. You can see the target. These are normally more conservative, but tend to go down less, except for natural resources, which is a huge tank right now. And then emerging markets are very risky, but it's other countries like India or maybe China, Africa, countries in Africa. And then you have foreign stocks, 22%, and then US stocks, 35%. What I like about them is this dashboard is really nice. It's easy to follow. Everything's automated. So for people who want to set and forget it and let them just invest the money for you, I really like Wealthfront. I like robo-advisors. The fees are pretty low, and they normally get back those fees for you by doing something called tax loss harvesting. And what tax loss harvesting is, really simply, is as things drop, they sell stocks, so you don't have to pay tax on it, and then they rebuy something else that's kind of similar. Supposedly, it offsets their fees entirely, so then you're actually not paying any fees, or it's a wash. But what I really like about Wealthfront and robo-advisors and who I recommend it to, so this is who I recommend it to. You're the type who you're gonna just either panic, and then every time you log in or every time you check your phone, you're gonna be tempted to buy or sell something. You're gonna end up spending a lot of time trying to day trade, or buy individual stocks. Or if you're the type that you want to have it be relatively safer, but not have as big of a upside potential. So I've read a couple articles from Options Alpha and some other places saying why robo-advisors are not good. And their argument is correct, where 100% stock portfolio is always going to end up doing better than a robo-advisor in the best case scenario. However, robo-advisors, Wealthfront and Betterment, their job is to get you not to panic and for you to be pretty diversified and keep you diversified so you have a very good chance of making a good amount of money, not the most possible, but also have a little bit of less of a downside. I'm going to show you in my other account, my retirement account. So this one is my SEP IRA. This one has $32,000 in. This one, my risk score is 8, still pretty high, but not as high. You can see my emerging markets, instead of being 25%, it's 16. Stocks a little bit lower, US stocks a little bit lower. Dividend stocks way higher, real estate added in, more bonds as well. So you can see everything is actually kind of up right now, right? For lifetime, everything is up. The only thing that's down is real estate, but that was only 15% of the portfolio. So not really that big of a deal, right? So if you're the type who you can't really trust yourself, you would be tempted to get a financial advisor and just pay him that fee, and you don't care about making the maximum possible, if you'd rather be able to feel safe and secure and knowing that it's probably going to do pretty good, you'd rather be a little bit more diversified, then robo-advisors actually are very good. You won't hear that many people recommend them because the people who are really into investing are super nerdy about it, and they're like, well, what do you mean you don't want to have maximum potential gains? You know, and it's because not everybody wants to live that life. It's kind of like, probably the best analogy is, are you the type of person who would rather shop around all day to save, you know, a couple of bucks on your groceries, or are you the type to just go, you know, some like Trader Joe's or somewhere that's like reasonably priced, and you're like, you know what, I don't care if it's the maximum cheapest, I just want a good value, good deal, know that it works. If you're the type of person who buys like Apple products, you're probably this type where you're like, I don't need the maximum possible cheapest, you know, value or the maximum speed. I just want it to be good and I want it to work. I don't want to think about it. Robo-advisors might be for you. For the rest of us who really just like nerding out, thinking about investments, planning everything, we like to kind of tinker everything. You know, people who enjoyed building their own, you know, computers or putting together, you know, like working on their car or even having Windows machine or having Android, you might like having a actual account with Vanguard or through Schwab and just buying Vanguard funds. If you're that type, here is what I would recommend. If you are still young and you don't plan on retiring in the next 5 or 10 years, there's not really a reason to buy bonds. You always hear these kind of splits, you know, 80-20 or 60-40 stocks bonds. The only reason why you want a bond that pays 4% or 5% is because it's less volatile. So it goes up and down less. So if we hit a recession, and we might be going on one now, the chances of you being able to sell your bonds for a similar price to what they're worth are much higher. So that's why if you are over 50 and you plan on retiring soon, you probably want to be mostly in bonds. You want to probably be 50% in bonds, sell those, withdraw from that, and then let a little bit of stock still grow so you still are in there. The downside of bonds is they make way less money. Stocks, you know, can have a year that makes 10, 20, 30%. It might have a year that loses 10, 20, 30%. It's a lot more volatile, but at the end of the day, stocks on average make a lot more money over time than bonds. So the next question is, which index funds or which stocks do you actually buy? I'll show you my account. I buy 3 of them. All right. One is VTI, which is Vanguard's total stock market index, which is, if you've heard of the S&P 500, it's kind of like that, but bigger. So the S&P 500 are the 500 biggest stocks in the US, the biggest companies in the US. A lot of people forget that when you buy a share of a stock, you're actually buying a small part in a company. And the S&P 500 are 500 of the biggest US stocks or companies. Vanguard's VTI, or they have another ticker symbol like that's the mutual fund version. Don't worry about the difference. They're almost the same. That is 3,500 of the biggest stocks in the US. That's a lot of stocks. And as I mentioned in the last video, that is like holding 3,500 lottery tickets versus if you buy one stock or one company, you're holding one lottery ticket. So why would you hold 1 ticket or 10 tickets that have the potential of making a lot, but also the potential of having it be worth nothing, when you can have 3,500 lottery tickets that are pretty much guaranteed to go up or be worth something? Not all of them will, some of them will fail, but as long as the world completely doesn't end or the US economy doesn't completely collapse forever and never rebuild, and remember, we have rebuilt the US economy many times, so I'm pretty confident it's going to come back, then having a basket of all these stocks is closer to guaranteed win. And on average, your portfolio will grow by anywhere between 7 and 10% a year, every year, and compound and end up making a lot of money. The other two index funds that I own are optional. A lot of people who are really into kind of the John Bogle way investing, the people in the FIRE community, financial independence, retire early, they just buy pretty much all US stocks. So traditionally that's been the top growing one. But here's the thing is what happened in the last 20, 30 years probably isn't going to repeat itself. That's why I also buy international stocks. So I buy a fund called VXUS, which is Vanguard's total international stock market. It hasn't been doing as good as the US stock market, and it actually drops faster, but it has potential to grow. And I believe that US is not going to be the big superpower it has been for the next 20, 30 years. So that's why I'm invested outside of the US as well. If you're from another country, or if you believe that America is not going to be the #1 economic powerhouse for the next 20 years, then have mostly international stocks. Or have VXUS be 50% or higher of your portfolio. If you think the US is going to do really, really well, then have VTI, the US stock market, be 50% or higher. It's up to you. Honestly, nobody knows what's going to happen. Nobody can predict the future. If anyone tells you they can predict the future, they're full shit. So just trust your gut or play it safe, do 50-50. The third index fund I have in there is kind of a gamble. It's the small cap value fund. It's VBR. The only reason I have that in there is I like the idea of supporting kind of, I don't want to call them small companies because they're still big companies, but not the top, biggest companies in the US. I think there's potential for those smaller companies in the stock market to grow. But that's way more risky. It's way more of a gamble. So I only have, I think, 15% of my my total allocation in that. But mostly, if you want to just get started, just keep it simple. Do 50% total US stocks, 50% total international stocks, or somewhat kind of a mix, however you decide. I would not recommend 100%, just US or 100% just international. I would always have at least 20% of the other one in there. The next question is, how much do you put in? Do you put all your money in right now? So if let's say you have 10,000 to invest, do you put all 10,000 in today? Or do you dollar cost average it in? What that means is, if you put it all in today, you have more time in the market, which means not only are you earning your dividend, which is on average 2%, so you're starting making money right now, but second, in general, the market slowly goes up. So in general, you are better off statistically to just put all of it in right now. However, I'm a big believer in kind of minimizing the downside, even if I have to sacrifice a little bit of the upside. And that's why I do like Robo advisors and have a little bit of money in there. I had a friend who messaged me about a month ago saying, Johnny, I want to start investing. How should I invest? I hopped on a call with her and I said, hey, you should probably dollar cost average in, put the same amount for the next 5 months in, instead of putting it all in once. And she said, okay. And it turns out she told her friend to do the same. And then the coronavirus pandemic hit and the stocks tanked. And she said, thank you so much for telling me to do that, because I would have put it all in. I would have lost so much money. So it is kind of like insurance to put it in over the next couple of months. Don't put it in over the next 3 years, because then you are losing money by not having enough time in the market. But put it in over the next 4 months, maybe 5 months max. Same day, over the next couple of months, and you should be pretty good. I do have a warning for people who use Betterment or Wealthfront. When you deposit money in your account, they actually invest it right away. It's kind of tricky because it feels like when you deposit it, it's just going into like a separate account and then you have to click something else. But no, they actually just deploy it right away. When you deposit money in your Vanguard account or your Schwab account, it goes into like a money market or, it's kind of like a separate account. So then you have to physically go in and invest it and tell them what you want to put it in. So both have their pros and cons, but just be wary of that. So don't put money in your Schwab account or your Vanguard account and then just think you're invested, because you're not invested yet. And then don't put all your money in Wealthfront or Betterment thinking that you can go in and slowly invest, because it'll get all invested that very first day. All right, and the kind of big last question is, what do you do right now during the recession? And it's a tricky question, because on one hand, if you buy as it's dropping, you will get a good price, but it might drop even more. If you wait, the price might go back up, and you might have kicked yourself in the butt, and because you missed out on these great prices. What I personally do is I put in the exact same amount every month on the same day of the month. I chose, I think, the 25th or something for no real reason. I just have it auto invest. It makes it really, really easy. That way you're not thinking about it. But during these kind of recessions where the prices are really getting dropped, I set up something called a buy order, where I'll set in my account, buy 10 more shares or buy 100 more shares if it drops to this price. And that makes it easy to buy more as the price is dropping. But at the end of the day, be careful how much of your cash you're putting in, because it might not come back up for a long time. It might be 3 months, it might be 6 months, it might be 3 years, it might be 10 years. So don't sell when it's down. And the best way to do that is make sure you have a cash buffer. I like to have at least 6 months of living expenses in cash in a savings account somewhere. You can have it in Marcus or Ally and still earn a percentage. Right now, Marcus pays 1.7%. That goes up and down all the time, but it has to be cash. Luckily, I live very cheaply. I live very frugally. I live full-time overseas. There's lots of tax breaks, but also the cost of living are really low. So I'm here in Sri Lanka. I'm surfing every day, and I am spending less than $1,000 a month. I spent less than around that, or a little bit less, in Thailand in the last couple of months. In the summer, I'm in Eastern Europe, where I might spend $1,500 a month. So on average, I'm always spending $1,500 a month or less, which means my 6 months of emergency savings can be 10 grand. It's pretty easy. If you're living in the US or somewhere expensive, 6 months of living expenses might be $30,000 or $50,000. So factor that in. And if you have kids, or even dependents, or if you have debt, make sure you factor that in too. Maybe you want to have 12 months or even 2 years of expenses on the side. But whatever it is, make sure you have that as a savings plan, because your goal is to never have to sell your stocks when they're down. That's when you lose money. Remember what I said in the beginning? If you have 1,000 shares, it doesn't matter what the price is, you still own 1,000 shares. And eventually, the market goes up, because with 3,500 shares or companies represented in those shares, most of them are going to end up doing well. A few of them might not. And this is why I don't buy individual stocks, because I don't have a crystal ball. But even if I did, you never know what's going to happen. Governments do these crazy bailouts where they might screw the shareholder. They might let a company go bankrupt and then rescue them again. So the company does fine, but then you as a shareholder doesn't. So watch my other video if you want more info on that, on how I got started with investing, and also why I don't buy individual stocks, even though I've gotten lucky. I firmly believe buying low-cost index funds is the way to go. That's what I would recommend. Hold it, don't sell it when it's down. If you want more info, if you have any questions, follow my links in the description. I've done a mega blog post on this where I outline everything. I have links to everything on johnnyfd.com. Me and my co-host Sam Marks, we recorded a podcast on our podcast, Invest Like a Boss, called Investing 101, How to Get Started for Newbies. That is a fun episode, but also goes into all the details, even more detail than in this video. Or you can ask me questions in the comments below. I'll try to help you out. But until then, make sure you subscribe, because I'm going to be talking about how I actually saved up enough money to start investing. Because I think that's the big question a lot of people have been asking me is, how do I even save up enough money to invest? And how do I even save up enough money to even have an emergency savings account? because to be honest, if you only have $1,000, you shouldn't be investing. Even if you have 10,000, but you have no savings account, no emergency savings, you shouldn't be investing. You should put that money into an emergency account, make more money, and invest that. And that's not what most people want to hear. So I know how hard it is. I got told the same advice when I made my first 30,000, which I thought was a lot of money at the time. And you know, this really smart guy named Dan, is an entrepreneur. He said, "Yeah, don't do anything with it. It's not enough. You know, just save it, work on your business, and then come back when you have more." And it broke my heart. It was devastating to me. So I don't want to give you that advice. But if you want to know how I got started, how I went from having just $1,000 in my bank account to saving up the first 30,000 through the Gold Watch Challenge, and then how I used this laptop, this MacBook Air from 2013, to travel the world and make me now over $700,000 from just this machine that probably needs to get updated soon, but it's so nostalgic to me. Let me know in the comments, because I would be happy to make a video about that. If you have any other questions, you want to have me make a video about something else, I'm gonna have a lot of free time these next couple of weeks with the quarantine and with the coronavirus. So I'm happy to make a video for you guys. Subscribe, leave a comment, and I'll see you guys in the next one. Take care.